But significantly, the credit boom was not associated with a marked expansion either in the demand for goods and services or in consumer price inflation. Now, the point I want to stress here is that there's nothing self-evidently wrong with this expansion in balance sheets and the associated rise in asset prices. Evidence from developing economies suggests that financial market deepening helps foster growth. And if financial innovation allows more households to access mortgage finance, one should expect that to lead to a rise in the relative price of houses. But just as there is evidence that increased financial intermediation is often a good thing, so there is also evidence from numerous past credit asset price boom-bust episodes that the juxtaposition of rapid credit expansion and sharp asset price increases is frequently a harbinger of a painful bust to come. Everything hinges on whether the underlying developments are sustainable or not. And the mistake of most of the economics profession, along with many others, was a failure to see what was really going on beneath the surface and to understand how disruptively things could unwind. Now, the proximate causes of the present crisis undoubtedly lie within the financial markets. But it's worth dwelling on the macroeconomic environment in the build-up to the crisis, as it helps set the scene. Now, this period was characterized by an unusually high degree of macroeconomic stability, with steady growth and low and stable inflation in most of the advanced economies. And that's illustrated in the chart, which shows the performance in the G5 countries, each of the G5 countries, before and after 1992, which I'm taking as the start of Great Moderation. For some countries like the United States, it arguably started earlier in the mid-1980s. F is France, K is the United Kingdom, J Japan, G Germany, S the United States. The italicized points are the average, the standard deviation of inflation and the standard deviation of output growth over the 1970 to 92 period, and the bold letters in the bottom left give you the average over the 1993 to 2007 period. So there's a marked improvement in terms of reduced volatility of both inflation and growth across all of these 5 countries. Now, there's 3 broad explanations for this great moderation, as it's often referred to. First, it could just have been a happy accident, if this was a period characterized by unusually small or a benign sequence of shocks. Second, changes in the structure of the economy could have meant that similar-sized shocks had smaller macroeconomic effects. Candidate structural changes included the shift from manufacturing to services, tighter control of inventories, and the innovation in financial markets. A final possibility is that better macroeconomic policies had moved economies closer to the eponymous Taylor frontier, tracing out the lowest achievable inflation volatility for a given volatility of the output gap. Now, if the Great Moderation was down to good luck, then improved macroeconomic performance was more likely to be ephemeral. But if it was the result of structural changes or of better policy, there was more chance of it proving permanent. Now, as it happens, the academic literature has so far failed to provide a conclusive answer on the relative contributions of the various explanations. But what matters is how market participants responded to these benign conditions. They were faced with what is in essence a complex signal extraction problem. But whereas many such problems in economics involve learning about first moments of the distribution, this involves making inferences about higher moments. The longer such a period of low volatility lasts, the more reasonable it is to assume that it's permanent. But as tail events are necessarily rarely observed, there is always going to be a danger of underestimating tail risks. And certainly, It appears from measures of volatility implied from options prices for US equities, that's the red line here from the VIX index, and from treasuries, the blue line, in the MOVE index, that the perceived risks in financial markets had shrunk to extremely low levels by 2006. There are two ways of rationalizing this. One possibility is straightforward extrapolation into the future of the benign experience of the preceding few years. An alternative and complementary explanation is excessive faith in the ability of policymakers to maintain steady growth in the real economy. The Fed's reluctance to use interest rates to lean against asset price booms, coupled with a willingness to relax monetary policy aggressively in the wake of sharp asset price falls, may also have helped place a floor under expected asset prices, the so-called Greenspan put. A tendency of people to underestimate future risks during periods of good economic performance seems to be a recurring theme in the history of financial markets. In part, there seems to be a mixture of a willingness or desire to believe that the world has changed for the better, and moreover, to find ways to rationalize that belief. In other words, this time it's different. To that must be coupled a limited imagination, shared in this instance, I have to say, with regulators and central bankers, to see quite how badly things could go wrong. But when market participants complain, as did David Vineyard, the Chief Financial Officer of Goldman Sachs, in August 2007, that they were, quote, seeing things that were 25 standard deviation moves several days in a row, unquote, it's a sign that something is wrong with market participants' estimation of risk. In case you want to know, a 25 sigma daily event should occur about once in every 1.3 by 10 raised to the power of 135 years. To put that in context, the universe is estimated to be just 12 to 14 billion years young. So the chance of getting 25 sigma events day after day is pretty mind-bogglingly small. A particular feature of this underestimation of risk lay in the prevalent assumption that bad shocks were likely to be uncorrelated with each other. Thus, the management of Northern Rock believed that if they were unable to roll over their short-term wholesale funding in the asset-backed commercial paper market, which they were heavily dependent on, then they would always be able to find an alternative source of funds in the interbank market. But as it transpired, the same forces that led to a shutting down of the former in August 2007 also led to the closure of the latter at all but very short maturities. By the same token, many investors thought they had purchased relatively safe securities because they were insured against default by either monolines or through the purchase of credit default swap contracts. But that insurance proved worthless when large correlated losses occurred and the insurer proved to have insufficiently deep pockets. A systemic financial crisis is apt to generate dysfunctions in multiple markets simultaneously, making bad tail outcomes much more likely to occur than they might appear when risks are treated as largely independent.